When will property prices finally drop? It is the question millions of renters are asking. The question first-time buyers who have been saving for 5, 6, 7 years are asking. Arguably the most important housing policy question in British politics. And I am going to give you the honest answer rather than the comfortable one, because the honest answer is not what most property content will tell you. Today, I am going through the structural data behind UK house prices, the 4 conditions required for a genuine nationwide price drop, where prices are already falling right now, and what the evidence says is actually going to happen. Let's get into it. First, the scale of what you are up against. Because to understand whether prices will drop, you need to understand why they are where they are. The UK government estimates the country needs 300,000 new homes every year to keep pace with demand. Between April 2024 and September 2025, approximately 231,000 net additional homes were delivered in England. That is a gap of nearly 70,000 homes per year. Every year that gap persists, the structural deficit between housing supply and housing demand grows. The Centre for Cities estimates that 6.5 million homes are needed to address the UK's accumulated undersupply. Planning approvals hit their lowest level since 1979 in late 2024. Construction sector output fell 2.1% in the fourth quarter of 2025, its largest fall since 2021. The government's own housing program is targeting 1.5 million new homes over this parliament, which if fully delivered would still not close the existing gap, let alone the annual shortfall adding to it. Here is the structural reality in plain language. Supply cannot catch up with demand at any delivery pace the UK planning system is capable of producing in the current decade. That structural imbalance is the primary floor under house prices. When supply is chronically short of demand, prices do not fall, they resist falling, even under significant economic pressure. Because the alternative to buying is competing in a rental market that is also chronically undersupplied. The average UK house price is 5.9 times the average salary, according to October 2025 ONS data. That is historically stretched. It is painful for anyone trying to buy. But it does not, by itself, cause prices to fall. Prices fall when sellers outnumber willing buyers at any given price. And in a market where rental supply is 23% below pre-pandemic levels and rents are rising, the alternative to buying is not cheaper than buying. It is simply differently expensive. Now, the 4 conditions that would actually cause UK house prices to fall materially on a national basis. Because it can happen. It happened in 2008. It happened in the early 90s. Understanding what produced those falls tells you exactly what is missing right now. Condition 1. Mass forced selling. In 2008, a credit crunch meant banks stopped lending, mortgages were called in, and homeowners who could not refinance were forced to sell regardless of price. That created a flood of supply at any price the market would bear. Today, 1.8 million fixed-rate deals expire in 2026. Some of those holders will face payment shock. But the Bank of England has stress-tested the mortgage market extensively, and the consensus is that while arrears will rise, mass forced selling of the 2008 scale requires a much larger employment shock than currently projected. OBR forecasts unemployment peaking at 5.3%, not the double-digit levels of the early 90s. Condition 2. A sharp credit contraction. 2008 happened because banks stopped lending, not because borrowers stopped wanting to borrow. Today, mortgage approvals are down 10% year-on-year, but still running close to pre-pandemic levels. Lenders are loosening affordability criteria, not tightening them. The stress test rate has been reduced from 8.5 to 6.5% this year. The direction of credit availability is accommodative, not restrictive. Condition 3. A severe demand shock. If the population of potential buyers drops sharply through emigration, demographic collapse, or a generational decision to stop aspiring to homeownership, demand-side pressure on prices would ease. UK net migration, while lower than its 2023 peak, remains positive. The population is projected to reach 70 million this year. The demographic pipeline of people reaching first home buying age has not contracted. Demand is subdued by affordability. It has not disappeared. Condition 4. A sustained rise in real rates above the natural rate. If mortgage rates rose to 8, 9, 10% and stayed there, the buyer pool would collapse under affordability pressure. The OBR, Goldman Sachs, and multiple forecasters project rates falling further through 2026 and into 2027. The direction is down, not up though. The Middle East conflict has introduced short-term uncertainty. None of these four conditions is currently present at the scale required for a nationwide nominal price drop. That is not good news for renters waiting for a crash. It is simply the accurate reading of the data. If this is telling you something you have not heard clearly before, hit subscribe. I cover this every week with the actual structural data. It costs nothing to stay informed. Now, where prices are actually falling, because the honest answer to the title question is not uniform. The question, when will property prices drop, contains an assumption that prices are not already dropping. That assumption is wrong in several specific markets. Westminster is down 20.9% annually. City of London down 22.2%. Crawley down 8.9%. Hartlepool down 9.5%. Aberdeen down 7.4%. East Anglia, the only English region in official annual decline. These are real falls happening right now to real homeowners. For the people inside those markets, the crash question is not a future event. It is the present tense. The pattern across every falling market is the same. The falls are concentrated in areas where one or more of the following is true. Prices were driven to multiples of local income that local buyers could never have sustained independently. An external buyer cohort, international wealth, pandemic migrants, financial sector professionals inflated prices and has since partially departed. The local economic base has structurally contracted with no replacement. Or a specific property type, leasehold flats, new builds, pandemic premium commuter homes, is facing compound structural pressures that are not shared by the broader market. These conditions create real falls, but they do not create the national floor collapse that the question is really asking about. So what is actually going to happen to UK house prices? The most likely trajectory, based on all available data and the consensus of major forecasters, is not a crash and not significant growth. It is a slow, real terms decline dressed up as nominal stability. The OBR projects average growth of 2.5% annually from 2026 onward. Inflation is currently running at around 3%. 2.5% nominal growth against 3% inflation is minus 0.5% in real terms. Every year that continues, property becomes marginally more affordable relative to incomes without anyone needing to call it a crash. That is the mechanism by which UK housing has historically rebalanced without a dramatic correction, not through nominal price falls, but through wages and inflation, gradually closing the gap between what people earn and what property costs. Halifax confirmed the house price-to-income ratio reached its lowest level in over a decade in December 2025. That improvement did not require a price crash. It required 2 years of wages growing faster than prices while prices stagnated nominally. This mechanism is slow, undramatic, and provides no relief to someone who needs to buy today but cannot afford to. But it is the mechanism the data supports, not the dramatic correction that makes headlines. Now the rental crisis that sits inside this question. Because for the millions of people waiting for prices to drop, the alternative is not free. It is the rental market. And the rental market in 2026 is its own crisis inside the housing crisis. Zoopla's March 2026 rental market report shows the average rent for new lets at £1,319 per month nationally. Rental supply remains 23% below pre-pandemic levels despite months of landlord exits. Demand has eased down 14% year-on-year, primarily due to lower net migration, but supply has fallen faster. The number of inquiries per rental property sits at 4.8, down from 6.5 a year ago, but still double the pre-pandemic average. Rental listing availability has fallen from 260,000 per month in 2017 to approximately 150,000 today. Here is the number that frames the entire housing crisis conversation honestly. The average private rent outside London now consumes 33.5% of gross annual earnings for a single person. That figure peaked at over 35% in 2023, the highest in 20 years, and has begun declining as wages outpace rent increases. But 33% of gross income on housing is still well above the 1/4 that financial planners generally consider sustainable for long-term wealth building. Renters waiting for a price crash so they can buy are simultaneously having their savings capacity eroded by a rental market that is taking a third of their income. The waiting strategy has a cost that most people do not calculate. Every year of renting at the current level is a year of wealth transfer from renter to landlord rather than equity accumulation. That cost compounds. A renter paying £1,300 a month for 5 years pays £78,000 to their landlord while their deposit savings grow slowly. If prices rise by even 2% annually over that period, the target they are aiming at moves away from them faster than their savings approach it. For renters waiting for the crash that makes buying obviously affordable, the evidence says that moment is unlikely to arrive dramatically. What is arriving, gradually, is improving affordability through real terms erosion and wage growth. The government's 300,000 homes per year target, if ever achieved, would accelerate that improvement. The planning reforms underway are the first serious attempt in a generation to change the supply trajectory. But delivery at scale is years away, and the gap is large enough that even successful reform will not produce a supply surplus that forces nominal prices down nationally. Here is the honest conclusion for the renters and frustrated buyers watching this video. The crash is not coming nationally. The affordability improvement is already happening gradually. The specific markets that have crashed: prime London, commuter belt, Aberdeen, crashed for specific structural reasons that do not apply everywhere. If you are waiting for prices to fall in Manchester, Leeds, or Liverpool before you buy, you are waiting for an event that the supply data says is not coming. If you are waiting for prices to fall in Canterbury or Crawley, they already have and may fall further. The question is never simply when will prices drop. The question is where, why, and whether your specific situation benefits from waiting. The housing crisis is real. The pain is real. But understanding the structural reasons why prices are where they are is the first step toward making the right decision about what to do next. Subscribe, and I will keep giving you the information you need. I will see you in the next one.